guys, average true range is one of my favorite indicators. Now, the reason I like average true range is because there's no directional component, there's no directional bias to it. It's not telling you it's bullish or bearish. It's purely showing you how much the market you're looking at on the chart is moving. Pretty much that's it. Now, the difference between true range and range are distinct. Now, true range is the larger of these three parameters, either the high minus the low for the day, or it is the high minus the previous day's close if it's an uptrend, or 3, it's the low minus the previous day's close. Now, these are normalized, so any negative values, forget them. It's normalized to be positive. So what does that mean? So it's taking the biggest of those three numbers. So generally speaking, if there is no gap, the average true range is, or the true range is going to be the high minus the low. So if the high was 15, the low was 10, that is going to be 5. The true range is going to be 5. Now, let's say, for example, we gapped up to 10 and we closed at 9 and the high was 15. Not to scale, obviously, guys, but the idea is, let's put these in so we can see that's 10, that's 15, and then let's say that's 9. Your true range is going to be 15 minus 9, so it's going to be 6 as opposed to 5 because you've got that gap as well. And similarly to the downside, if you've got a high, let's use the same kind of thing here, a close of 15, and then the next day you open at, say, 10, and then let's say you trade down to 5, your true range is going to be 10 because it's going to be 5 minus 15, just the difference between the two. Forget about your negative signs and all that kind of stuff. So with that in mind, it's a really good tool to show you how strong or how weak the volatility is. So let's look at this, and what I've got is I've got Spider's ETF up here, and we'll show some more things in a minute, but I've used this. In fact, you know what, let's use something a little bit different. Let's go with Facebook, stock that we all know and love, and some of us have traded it, some of us haven't. What we all know about Facebook. So I've got ATR on a setting of 14 here, and that is ATR is the average true range. We just talked about what the true range is, so it's the range, or it's the difference between the gap. We've gone through that. The average true range is exactly what it says. It is the average true range over the period that you put in as the setting. Now, the default for most things is 14, but again, use whatever setting you want to use. There's no right or wrong way for that, but the default for most packages is 14. So 14 days is giving you the average true range over a 14-day period. So how do you use it? Well, ultimately, if you see here and compare it to the chart, it's showing you how volatility picks up its peaks and its troughs. So as volatility starts to increase, we get these gaps here, true range starts to spike. It doesn't obviously show itself yet in the average calculation because it's an average. So it starts to get these more volatile periods here. You start to see a spike, and then it starts to tail off as things start to calm down. And then when you get into this chugging trend, you can see that true range just dies lower and lower and lower. So the idea is that you can the good one way, there are various ways of using it, and again, dig deeper if you want to go into it and want to really dig down into average true range, feel free. It's a great tool, but one good way of using it is to use it as a kind of stop tool. So you can say, listen, I know the average true range on my 14 period here is $2, right? So it's $2, so I can say, okay, I'm going to use a stop from my swing trade that is 3 average true ranges on a 14 period, so $6 stop for a swing trade. Okay, it's a way of kind of keeping yourself in the market but not getting pinged out by noise. Or you can say, listen, there's the average true range, it's running up now, we're up to like $3 or $4 here, so I've got to really expect that noise is $4 if I'm trading on a swing perspective, so I need to frame my trade around that. So again, just some ideas, no right or wrong, but it's a good way of looking at it. Now, one way I like to use true range is I like to use a 1 period. Why do I use a 1 period? Because that is showing me it's not as we talked about, it's not actual range as in high minus low because it takes into account gaps, but for me it's a good visual way of kind of looking at the price candle. Then I can look at the range of the day, then I can look at the volume of the day, and I can start to see potentially when there might be opportunity. So if there's been a big range and we've gapped down, and I can also put alerts on this as well. So if I set it to 1, I can put alerts that say, hey, if we go above a $3 range on Facebook, I know something's going on. I don't need to get involved all the time in it, but I know that perhaps I need to look at it. And even though that is a true range as opposed to a range, it's going to get me involved if there's something that's gapped. That's a good thing about the true range, by the way, guys, is that if it's gapped and still not done a lot, it's still going to alert you because there's still been something of volatility there. Something has fundamentally repriced that stock or that market. That's what the true range is telling you, is that people are revaluing this based on an external catalyst, an internal catalyst, or whatever it may be. But as a trader, when you're not caring so much about the valuation of the stock, but you're more interested in getting involved in momentum and volatility, then the true range is a great way of being alerted to something like that. So 1 period, that kind of thing. Another way to use it very quickly, very briefly, is if you're using it on a 5 minute. And in fact, let's go to something a little bit broader, like let's go with the DAX for a change. Give the Germans a bit of love. We've given the British and the Americans with the FTSE and the Dow. Let's go with the DAX for a bit. So you can see, as the price starts to open, a market starts to open, should I say, the true range is, that's a bit of a bad example, and I don't like cherry picking stuff. Let's use today. As we open, we get some spikes in volume, and then generally as you kind of know, let's put the drawing pen back on. As you know, if you've been trading a while, or if you haven't, volatility kind of goes in waves. You get spikes and then it calms down a bit, get spikes and it calms down a bit. Sometimes you get like a secondary spike, but ultimately that's generally what happens. Spikes in volume and volatility. A contraction, expansion, a contraction, expansion. So the idea is that here's the open, the cash open. You get a good sort of volatility move, and the ATR's high, and then it starts to calm down a bit. And then there's some sort of spike here as we break out to new lows, and then it sort of calms down a bit. So you can see the ebbs and flows. Unless if we change that to say, if we're day trading and we're on a 5 minute, let's do a 5 period, and that's going to give us quite a nice smoothed vision of what the true range is. And something as well that I always like to do with indicators, using them as filters. Look at the filter here. If you look at the prior day in this specific example, after you've had this move, a good drive up, this thing just goes dead, and the average true range just goes really, really low. So one thing that I always like to do is I like to say, now obviously I have it on a 1 period, but you can smooth it off with a 5 period or whatever, is that you can say, listen, if I'm day trading a specific instrument, I do not want to get involved if the average true range is below X, or it's in the lower half of the day's overall average, or whatever. Some kind of structure to it and boundary that means that you're not getting involved. Or I guess one caveat we could say to that is, if you're trading a mean reversion, perhaps you don't want to be too involved in high volatility. You'd rather be involved in low volatility. But honestly, I would tend to err on the side of, when it's low volatility and it's chugging around, price is doing nothing, average true range is low. If you're a day trader, look for something else. Either go home for the day, shut up shop, or come back, set an alert for when ATR breaks out again, and look at the next day, because this kind of chop is very, very challenging to trade as a day trader. So that's true range. As I say, there's loads of ways of using it. I like to use it that way. Other people may use it differently. Some people use it to highlight contraction and expansion on much higher time frames. Some people like to use it in conjunction with looking at correlated markets. But I say, go and do some Googling if that takes your fancy. Really good tool. It's not directional, but it's a good indicator of volatility.